if you know anything about mortgage insurance, you probably think that it's either a blessing for those who have a smaller down payment, or you might think it's the devil if your parents are involved in trying to convince you not to buy until you have 20% saved, or if you're listening to Dave Ramsey, who's kind of saying the same thing. And I am a big fan of mortgage insurance, especially today, because it will allow you to get into a home with a lower down payment right now. And really, there's not much of a penalty. I've not always been a fan of mortgage insurance because it's been relatively expensive in the past. So here's a little peek behind the curtain about mortgage insurance. Number one, let's talk about definition. So mortgage insurance is an insurance policy that protects the lender or the investor in the mortgage, the person who's holding the mortgage, against default in the event that you stop paying your bills. And so this does not protect you in any way by paying your mortgage if you hit some sort of a hardship. It only protects the lender in the event that they foreclose on the home. So then it pays, this insurance policy pays them back some damages. So it's a way that the mortgage companies can mitigate the risk of a lower down payment borrower. So that's seen as a more risky loan. That's why mortgage insurance came into play many, many years ago. The reason that mortgage insurance is so cheap right now is that the rate of foreclosure is almost non-existent. There just aren't many people who are foreclosing on their homes, and so there's not a lot of claims coming through the mortgage insurance system because everybody's paying their bills on time, and so the rates have gotten really cheap. Now, a couple of things about mortgage insurance rates, and I'm going to talk about some very specific raw numbers here. Given as an example only, this is not an offer to lend, all the mortgage company disclosures, all of that stuff. I'm giving you some examples. These are real life examples that I've priced today. So I'm a mortgage broker. I've been in the business about 20 years, and I've wound up on the broker side because it's just a more efficient way to do business, and I'm able to offer better pricing to my customers in a myriad of different ways. And one of those is mortgage insurance. What I didn't know for probably 15 years was that mortgage insurance was one of the ways that mortgage companies make money. Now, I always knew that bigger companies were able to negotiate maybe better rates with the mortgage insurance companies because of volume. That's a typical thing to expect in corporate America. But what I didn't know is that a lot of mortgage companies are then adding on. They may negotiate a lower price, but then they're adding on their own premiums just simply as a revenue stream. So I'm not faulting them, but I'm saying that for my model and trying to get the best deal for my customers, I had to go over to the broker side and find a more raw pricing kind of model. And so I do business. It's not the only company that I do business with, but I do business with the company who has the lowest mortgage interest or mortgage insurance rates in the business. And that translates into some significant savings and can really make the difference between a deal that works and doesn't work. So some very real life examples. I'm going to take the minimum down payment examples of an FHA loan and a 5% down conventional loan. I'm going to probably choose an FHA loan as the more efficient model if my borrower has a little bit challenged credit scores. I'm going to go to the conventional side if the credit scores are a whole lot better. FHA has a mortgage insurance model where they charge an upfront premium, which is financed into the loan, and then they charge a monthly premium that's it varies a little bit with the down payment amount, but it's always the same, and it just runs through the course of the loan. So the FHA mortgage insurance premium is currently 0.55% per year. So you take the loan amount times 0.55%, that's a little more than 0.5%, divide or multiply that times the loan amount, and then divide that by 12 to get your monthly mortgage insurance premium. On the conventional side, conventional loans are going to be very risk graded. So they're going to grade based on the percentage of down payment. They're going to grade on credit score, loan type, the number of years in the loan terms, shorter terms being less risky than longer terms. So a lot of different ways that monthly mortgage insurance is calculated in the conventional world. But in the best credit scenarios and low down payment, it's very, very cheap. So I priced a $400,000 loan amount, which puts you, around the 420, 425 range for both an FHA and a 5% down conventional. Priced those this morning. And remember I said that the FHA is going to price out at 0.55%. The conventional loan prices out at 0.19%. So about 0.2% versus 55 bips or a little over 0.5%. Very, very cheap. So when I did these numbers on a $400,000 loan amount, I've got $183 on an FHA loan on a monthly basis, $183,000, $425,000 purchase with around a $400,000 loan amount. And the conventional, drum roll please, is about $65 a month. So very, very affordable. So if you got to take this a little bit further down the road and think about, if you're a person who really wants to be rid of mortgage insurance and you're thinking that you should save up the 20%, you've only got 5% now, but you want to save up the 20% so that you don't have mortgage insurance, you got to think about how long it might take you to save another $60,000 on that $420,000 purchase price, because that's what it's going to take to get you to that $80,000 20% down mark. So if that, then you also have to think about, in the period of time that it takes you to save that extra down payment, and let's say that that's 3 years, that's my example, you've also got to take into consideration how much that house is going to appreciate during that period of time. So in 2023, we're in the first quarter of 2024. In 2023 was actually one of the slowest years in real estate in recent record. And we had over the average of the 4 most trustworthy home value indexes, we saw an appreciation of the home value at almost 7%. So I took a number of 6% to try to be conservative about that. And if your $400,000 or $420,000 house appreciated 6% over the next 3 years while you were waiting to save up your 20% down, it would be worth an extra $80,000 in that 3-year period of time. So the FHA cost, so you got to think about it. If the house is worth $80,000 more, I'm buying it $420,000. Now, 3 years from now, it's a $500,000 loan or a $500,000 property. How much did it cost me to wait? Well, it cost you $80,000 in appreciation. Plus, and I didn't even calculate this in, but you got to live somewhere, so it also costs you significant amount of rent in that period of time. If you had gone ahead and bought a property now instead of waiting for 3 years and paid mortgage insurance on that loan for 3 years, the FHA loan would cost you $6,600. Okay, so extra $6,600 in payments, but you made $80,000 in equity. Or if you were in fortunate enough condition credit-wise to do a conventional loan, that conventional loan cost you $2,400 over the course of a full 3 years. So you get an $80,000 return on an extra $2,400 investment. So it's very interesting to go ahead and get in there and dig around and do the math. Then you also, I think, have to consider how reasonable it is that while you're saving money, renting, paying utilities and doing all that, you're paying a full boat of living expenses. You've got to save money on top of that. If you were to save enough money to do a 20% down payment over that next 3 years on a $400,000 or $425,000 house, then it would cost you about, or you'd have to be saving about $1,600 a month. But remember that it's a $425,000 house from 3 years ago. So now that house, 3 years in the future, is worth $500,000. How much is it going to take to save $100,000 total? Started out with 20, $100,000 total. So now you have to save $80,000 to buy the same house 3 years from now that you could have bought today. And that's going to cost you, or actually you're going to have to save an extra $2,200 a month just to make that 20% down payment on the same house. So when you start looking at the value in, number one, in appreciation, and then the actual cost to go ahead and pull the trigger earlier, it really is difficult to find a situation where you can justify mathematically waiting on buying a primary residence. There may be some things that you need to square away. Maybe you've got a significant credit challenge. Maybe you need to have a derogatory credit event to season out, and maybe you just don't have any money saved at all. But I would take the whole vernacular and the whole concept of a 20% down payment being necessary to buy a piece of property, take that and throw it out the window. FHA is going to start with very fair interest rates at 3.5%, and then conventional is going to be great market rates at 5%. The conventional, as I said earlier in the video, is going to require a better credit score in order to take best advantage. So, hope this is helpful to dispel some of the myths that are being promoted about mortgage insurance. Mathematically, you just cannot make sense out of waiting to buy a home based on down payment amount and mortgage insurance.